Let's talk about three massive economic stories that are shaking things up right now. On the surface, they look totally unrelated, but they're not. When you connect the dots, they tell what might be one of the biggest financial stories of our lifetime.
First up, let's talk about gold. You know, the oldest money on the planet? Well, it just completely shattered its all-time high. I mean, some analysts are even projecting it could rocket up to nearly $3,800 an ounce. A surge like this, it's got everyone scrambling for answers.
At the exact same time, you've got this powerful block of nations, and they're intentionally moving their business away from the US dollar. This isn't an accident. It's a direct challenge to the global financial system we've known for decades.
And then there's this number. Check this out. Despite some pretty massive tariffs designed to slow China down, the country's on track for a mind-boggling $1.2 trillion trade surplus this year. Just incredible. So you've got record gold prices, a challenge to the dollar, and this huge shift in trade. Are these just random, isolated events, or are they all pieces of the same puzzle? Well, that's exactly what we're going to break down right now. Okay, let's start with the first piece of this puzzle, and that is a direct, head-on challenge to the US dollar.
So the new development bank, this is the one founded by the BRICS nations, is issuing $500 million in bonds. But here's the kicker. They're not doing it in US dollars. They're doing it in Indian rupees. And this isn't their first rodeo. They've already done this with China's yuan and South Africa's rand. It's a crystal clear move to build a whole new financial system using their own currencies.
And there's actually a name for this strategy. It's called de-dollarization. It's this very deliberate effort by countries to cut back on how much they rely on the dollar. Why? Well, it gives them way more control over their own economies and kind of insulates them from US financial policy.
And make no mistake, this isn't some fringe idea. The big players, the major investors, they are paying very close attention. You've got strategists like Vivek Rajpal pointing out that this de-dollarization trend is pulling in capital from people who see this global power shift happening, and they want a piece of the action.
And listen, this isn't just a one-off thing. If you look at the BRICS bloc's official priorities, you can see it's all part of a coordinated plan. They want to build an entire parallel economic world, from payment systems to trade deals, that just operates completely outside the traditional dollar-based system.
All right, on to the second piece of the puzzle, gold. And what's fascinating here is that its massive surge isn't about the thing we usually talk about, fear of inflation.
Analysts like Florian Grummis are arguing that this is really about one thing, power. It's become a race to get a hold of a neutral asset, something that no single country can just print more of or control.
I mean, just look at the numbers. The sheer scale of how much gold is outperformed is staggering. We're talking up over 43% year-to-date. That completely dwarfs the S&P 500. This isn't just investors slowly creeping into a safe haven. No, this is a full-on sprint. And that signals a huge shift in where the big money is trying to find safety.
So, who's doing all this buying? It's not just your average investor. Nope, the world's central banks are the main drivers here. They've been buying over 1,000 tons of gold every year since 2022. That's nearly double the rate they were before. We're literally watching nations stockpile physical gold at a historic pace.
And this kind of reveals the end game. See, China isn't just buying gold, it's building the entire infrastructure around it. By inviting other countries to store their gold reserves in Shanghai, it's making a direct play to challenge London and New York. It wants to become the world's new center for gold.
Okay, that brings us to the final piece of the puzzle. And this one isn't about money exactly, it's about the actual goods we buy and sell. The physical trade routes of the entire world are being fundamentally redrawn right before our eyes.
So, you remember the US imposed these huge tariffs, right? The goal was to curb China's economic power. But here's the thing. The result, maybe unintended, was a record surge in Chinese exports. Their manufacturers just pivoted and found new customers.
So where did all those goods end up? Well, for the most part, in other BRICS nations. Nearly half of the goods that were once headed for the US got rerouted. And in the process, they've created these incredibly resilient new trade networks that completely bypass the West.
So let's step back and connect the dots here. We've got a challenged dollar, skyrocketing gold, and completely rerouted trade. When you put it all together, what does this new picture actually mean?
When you lay it all out, the pattern becomes pretty clear. Step 1. You challenge the dollar to get financial independence. Step 2. You stockpile gold because it's neutral and it's a sanction-proof reserve asset. And step 3, you reroute your trade to new partners. These aren't random events. These are calculated steps in a massive global economic realignment.
But what's kicking this all off? What's the catalyst? It really comes down to a growing nervousness. A nervousness about the massive and, frankly, unsustainable debt levels in a lot of Western countries. As interest rates go up, just paying the interest on that debt becomes a huge risk, and that's pushing investors to look for safer alternatives.
Which, of course, leads to the big question for anyone with a 401k or a savings account. What do you do? How do you navigate this new environment? What's the playbook here?
Well, for investors, the playbook seems to be focusing on assets that are outside the traditional system. Those same worries about global debt are what's making precious metals like gold and maybe even silver look attractive. The big takeaway here seems to be diversifying your portfolio internationally to lower your risk. And the good news is getting access is pretty simple these days through common ETFs.
And all of this leaves us with one final massive question to chew on. Are we just looking at a temporary market cycle, something that'll just blow over? Or are we actually watching the blueprint for a brand new global economic order being drawn up in real time? The answer to that question is probably going to define the next decade.